Silver has skyrocketed by 40% in just 6 months. Gold is up as well, but by 20%. So the big question is silver the next gold or is it the next trap? In this video, I'm going to share with you a silver and gold investing strategy based on 35 years of market data. I also reveal a dark side to silver that a lot of people are ignoring. And finally, I will also share the best ways to invest in these metals from India, one of which includes a secret but very easy way to get about a 15 to 24% discount. Hello everyone, I am USDINR and I've been licensed in Indian financial services since 2015, and so far I have helped over 2000 families make better financial decisions. And here on my YouTube channel, I talk about all things money and personal development. Let's start with a hidden number that has told us when silver has beaten gold and when gold crushes silver. It's called the gold to silver ratio, and it's quietly flashing a signal right now. It first began about 6 months ago. The gold silver ratio tells you how many ounces of silver you need to buy 1 ounce of gold. Right now, the ratio sits at 80, which means you need 80 ounces of silver to equal the price of 1 ounce of gold. Now, why does this matter? Because historically, this ratio has been a powerful indicator of when silver is undervalued compared to gold and when it might be time to make a move. And using this ratio for the last 35 years by using data across an entire time frame, I've created an investment strategy that uses the gold to silver ratio. Since then, there have been 2 instances when the ratio crossed above 90. And as per this strategy, you buy silver when the ratio crosses 90 and you sell it and buy gold when it reaches 50. So here we go, right? Right now, the ratio is at about 80, 81, but these are the 2 instances, right? First in about 1990 when the ratio crossed 90. Then with this strategy, you essentially buy silver at this point in time instead of gold, and you keep holding silver until the ratio goes to 50. Then when it goes to 50, you buy gold, you keep holding gold until the ratio once again goes to 90 when you buy silver. So here you will see that the ratio last crossed 90 in July 2019, which is when you would again buy silver and not buy gold. The ratio still hasn't hit 50, so you'd still be holding silver. We'll see how that would have performed. The first instance of it crossing 90 was in October 1990. It went under 50 in December of 1997. Now during that period, silver would have returned 143%. Whereas gold in the same window would have returned 63%. And if you're wondering, the Sensex at that time would have given about 155% returns. Then from the time the ratio crossed 90 in June 2019, gold has returned 275%, which is stellar. But during the same window, silver has returned 320%. So both have done well, but silver's performance has been marginally better. The Sensex at the same time has been up by around 100%. Now, since the last time the ratio crossed 90, which is when you would essentially buy silver, look at how the different asset classes have performed, right? Silver is up about 320%. Gold has given exceedingly high returns, but is still lower than silver at almost 290%. Whereas the Sensex is at around 120%, right? So the difference is very stark. And you can see how buying these precious metals would have played out. Right now, this ratio sits at about 80, which means that it's not as, say, high as 90, but it's still closer to that upper limit, right? So it still warrants a buy as per this strategy, and you don't yet have an exit signal. So you basically keep holding it until the ratio hits 50. But before you rush to buy silver, let's zoom out and look at the bigger picture. Because short-term excitement is one thing, but long-term performance is something else entirely. Now, I'm going to show you the price of silver in terms of the US dollar. And here you go, right? You will see something very interesting. Look at the price in 1980. It was about $48. And look at what the price is right now, $48. Do you see how much silver fell by from about 1980 onwards since this high? If you had bought silver then, in 2011 April is when it would have hit $48, but it again started going down and it's again at $48. So for 45 long years, you would have seen zero returns on silver if you had invested a lump sum amount back in 1980. But the good thing is, you and I are buying silver in Indian rupees, right? And the rupee has consistently depreciated against the US dollar. So the returns that you and I get are the silver returns in US dollars plus the depreciation of the rupee. So because of that, as you can see, in the last 5 years, silver is up 30%. Like I showed you earlier, gold is up to 90%. If I stretch that, right, if I stretch this entirely from 1980 onwards in US dollar terms, silver returned 0, right? But just look at from a rupee perspective. I'll zoom out further and there you go, right? So silver has returned 6,000%. Gold has done extremely well at about 14 to 15,000%, which is crazy. Now let's look at different timelines, right? Let's look at since 2000, how these asset classes have done. Again, gold has outperformed silver to a large extent. Then if you look at returns from about 2003, 2004 onwards, you will see that they are very similar until now 2025 when I'm recording this. But you'll notice if I keep changing the timeline, the returns of these two asset classes really starts to become very different, right? At some points they converge, at some times they are similar. But this just gives you an idea as to how these two asset classes have performed, right? And then in the recent past, you will see that silver actually started outperforming gold, right? If you're looking at the last few years. If you've been watching my videos, you'll know that I really don't like looking at point-to-point returns or CAGR because that skews the picture, right? So let's look at rolling returns, which give you a better idea of consistency. Now the 5-year median rolling return for gold is 12.04%, whereas for silver, it's 10.88%. At the same time, gold has given negative returns about 9.4% of the time, whereas silver about 1/4, that is 25.2% of the time on a 5-year rolling basis. The number of times they've given over 15% annual returns over a 5-year window is very similar. It's also important to consider how bad it can get when these asset classes don't perform well. So for that, let's look at how they have performed every single year since 2005. If I just highlight the negative return, then you will see gold, silver and Nifty 50 here. If I just highlight negative returns, you will see that gold has given negative returns 4 times, but it has never fallen by more than 8% in a calendar year. Isn't that crazy when you think about it? Whereas if you look at silver, it has given negative returns 10 out of 20 years. And the biggest fall, right? The biggest fall was basically 20% back in 2014. The stock market has given negative returns 3 times and the biggest fall was 51%. So this tells you a lot about consistency of returns, about how big the falls can be. And if I just go back to the entire picture, right? So if you notice for silver, it has given very high returns in certain segments. So the biggest high return year was in 2011 where it gave 108% return. Then there was a 63% return in 2006 and then 2023 was a 42% return. So quickly there's a story that emerges here, right? Gold, if you notice, has consistently given returns within a certain range. When it falls, it doesn't fall by a lot. And it doesn't tend to fall anyway frequently. Whereas with silver, that is not the case at all. In fact, if I had shown you silver returns without telling you it was silver, you may have very well said that you were looking at the returns of the stock market, right? Just because of how all over the place they are, how extreme they are on the higher side, on the downside, how many times they've given negative returns in a year. So that's something to consider as we make this analysis. At the same time, gold's volatility has been 14.7%, whereas it was 26.6% for silver and 26.8% for the Indian stock market, which is the Nifty 50. If you want to apply what I share here on YouTube to your own life and investing, check out my program, The Complete Guide to Mutual Fund Investing. It has all my years of experience of being licensed in Indian financial services since 2015. In it, I've covered topics like how you can select mutual funds to invest in, how to build your mutual fund portfolio, a much deeper dive than this particular video, what is an SWP and how to plan for your various goals, among other topics as well. The guide also has Excel tools like this one where you just enter the goal that you have, the money that you require for it, and it automatically tells you, factoring in inflation, how much you need to invest per month from now onwards and which mutual funds to go for to save for that goal. Once you sign up for the guide, you'll also be part of our monthly live Q&A sessions where I answer all your doubts. To check out the program, go to the first link in the description and the pinned comment. Then understanding why these metals behave so differently also helps us make better investing decisions. Gold is considered to be the classic safe haven asset. Central banks around the world have been buying gold aggressively over the past few years. According to the World Gold Council, central banks added over 1,000 tons of gold in 2024, marking a third consecutive year of buying more than 1,000 tons. India's Reserve Bank of India also purchased 73 tons of gold in 2024, and that was 4 times higher than its 2023 purchase. Now this institutional buying and this demand provides a wonderful floor under gold prices and makes it a reliable store of value during times of economic uncertainty. When stock markets crash, inflation spikes or geopolitical tensions rise, investors flock to gold. It's been that way for decades, and the last few years have been a classic example of that in play. Russia's invasion of Ukraine was a classic example. The moment that happened, a lot of countries led by the US sanctioned Russia, and what they stored in US dollars was essentially frozen overnight. And that was a big wake-up call for countries across the world to understand that the dollars they hold in their vaults are not really as safe, right? Because overnight they can be frozen if you do something that isn't aligned with the superpowers in the world. So then a lot of central banks started buying gold because nobody can lock up the gold that you hold, right? Because it is a universal asset. There's no one currency that controls it. So that's what led to the massive buying of gold by big central banks, and that has created this massive floor in gold prices. Silver, on the other hand, wears two hats. Yes, it is a precious metal and it has some safe haven appeal, but more importantly, it's an industrial metal. About 60% of silver's demand is used to satisfy industrial use cases. These include applications from solar panels to electronics, batteries, and even medical equipment. This dual nature is both silver's strength and also its weakness. Because when industrial demand is strong, like what we are seeing right now with the push for renewable energy, silver can really surge. In fact, even in 2011, when you saw the 108% rise in silver, that was one of the major reasons. But when economic growth slows or manufacturing contracts, silver really gets hit because its industrial demand drops. And this brings me to a critical question, and take a second to answer it. Why are you even considering gold or silver in the first place? Why do you want to add it to your portfolio? In most cases, the answer is simple: diversification and hedging. So think of gold and silver as your portfolio's insurance policy. They behave differently from stocks and bonds, which means when markets get volatile or they crash, precious metals often hold their value or even rise. But here's where the numbers tell a fascinating story. Let's talk about correlation, a measure of how two assets move together. A correlation of 1 means they move perfectly together. So if one rises, the other will also rise. A correlation of -1 means they move in exactly opposite directions, right? So if one moves by plus 10%, the other would move by minus 10%. And 0 means there's no relationship. Ideally, you want to be as close to 0 as possible when you're using different assets to build your portfolio. Gold and silver were moderately correlated at 0.6. Reflecting that they have some kind of shared similarities because of the safe haven demand. What about silver and Nifty? The correlation was slightly negative at 0.28, which is wonderful, which means sometimes silver zigged when equities zagged. What about gold and the Nifty 50, right? Gold and stocks. The correlation was also mildly negative at minus 0.13. These negative or low correlations make precious metals a useful diversifier in equity-heavy portfolios. So now how should you go about investing in silver and gold? I'm going to share with you two approaches. One is if you're adventurous and want to take on higher risk, and the other is if you want a more standard, straightforward way to invest in these metals. If you're chasing those explosive silver returns, then definitely use the gold to silver ratio. When the ratio spikes above 90, that's your sign that silver might be undervalued compared to gold, and that could be a time when you could consider adding some silver to your portfolio. Then when the ratio starts to go down back to say 50 or 60, consider taking out some profits and diverting that back to gold or other assets. Now this is an active strategy, right? It's a tactical strategy. It requires watching the ratio constantly and being willing to make moves based on what the ratio suggests. But if you just want a simple, reliable hedge without constantly monitoring ratios and making tactical calls, then gold is the obvious, better, no-brainer choice. It's less volatile, it has lower drawdowns, and it serves its purpose as portfolio insurance more effectively. Silver just moves too wildly, right? I'm going to go back to this chart to just highlight how wildly silver moves. And now I want you to look at investing in silver through this lens, right? The returns, yes, at times can be higher, but if you just look at consistency, would you be okay with handling so much volatility? If the answer is yes, then obviously go ahead and invest in silver. Use the ratio to get some sort of an idea. Use that as a guide, but only if you're comfortable, right? The ideal allocation in any one of these metals or even both these metals, I would say anywhere between 10 to 20% of your total portfolio. Personally, I lean more towards 10 to 15%, and honestly, all of that is in gold. I don't invest in silver, or at least I haven't yet. And that's primarily because of just how wildly silver moves and how fragmented the returns are. And finally, how should you buy gold and silver? And yes, I'm going to share what I promised, which is a way for you to get a discount of up to 24% while buying them. Firstly, what are the popular options? So let's say buying gold physically or silver physically, right? That attracts a very high GST and even high making charges, which reduces your returns. So think about at least 6 to 7% lower returns if you go for this method. The second option is buying them digitally through digital gold or digital silver. The problem here is it again attracts GST of 3%, and there's the bid call spread, which once again reduces your returns. So again, think of it as at least a 5 to 6 or 5 to 10% lower return in some cases if you're buying them digitally. Then comes gold mutual funds and ETFs, which could be viable options. Now ETFs, if you look at just purely numbers, they have the lowest cost that you incur when you're buying them. But again, when you're buying ETFs, whether it's gold, silver, or even any stock related ETF, just check out for the spreads, right? So what is the underlying price of the ETF and what is the price it is trading at? Because if there's a big difference, you again lose out on returns. ETFs charge a small expense ratio for you to be able to invest in them. The other way you can also consider investing is if you want to keep everything under the wrapper of a mutual fund. So then you can consider a silver or a gold mutual fund. Here the drawback is that you're paying two expense ratios, one expense ratio of the mutual fund and one of the ETF. So it's marginally higher in cost than ETFs. But if you compare it to the other options, it just becomes a great way to invest if you want everything in the umbrella of mutual funds. And finally, if you really want to hack your way to getting large discounts while buying them, you can purchase Myntra gift vouchers from the HDFC Smart Buy or ICICI iShop portals. With a premium credit card like the HDFC Infinia, you get 16.67% back of the value of the Myntra voucher, and Myntra further has a coupon for about 6%, which gives you total savings of 22.67%. Then HDFC Bank's Diners Club Black credit card also gives you 9.99% back on Myntra gift cards, and the 6% Myntra coupon code also stays consistent, giving you, if you think about it, about a 15.99% saving. You can also use a very basic credit card, which is also excellent, like the ICICI Bank Amazon Pay card, which gives you 4% back on the Myntra gift voucher and 6% back on Myntra. So your total saving becomes 10%. And this is a very common entry-level card, right? Whereas the others are more premium. The ICICI Emerald private card gives you a discount of 24%, which is 6% on Myntra and 18% through the voucher that you buy. Through these vouchers, you can essentially buy physical gold bricks or even coins from Myntra. Just make sure the quality of it is up to the mark. You can scan the HUID code using the BIS Care app so that you know that the quality that you're getting is actually accurate. And if you enjoyed watching this video, then check out my other video on the gold to Nifty ratio, where I again crunched 35 years of stock market data and found something surprising about how to and when to switch between gold and stocks. This particular technique turned 10 lakhs into 90 crores versus only 4.5 crores if you only invested in gold and only 6 crores if you invested only in the stock market. I'll see you in the next one.